I think there are a couple of thoughts, right? One is the idea of a broad-based demand destruction in terms of affecting the overall economies, right? And I did mention in my musings an interesting scenario analysis that Morgan Stanley did, where they projected a 500%, so an important number, 500% increase in the wholesale price of natural gas in Europe, and extrapolated out what they thought that would mean for European GDP next year. And broad European GDP is forecast to grow about 4.5%. And their conclusion was that a 500% increase in the wholesale price would take off roughly 40 basis points of GDP growth. So 40 basis points out of 4.5%, not even really 10%. With a 500% increase in the wholesale natural gas price. So I think that is those kinds of things I think are helpful, and I keep my eye peeled for that type of stuff because it puts things in context. All the headlines, all the news, anyone, you can get all hyped up and all worried about stuff, and then you sell and you realize, like, 6 months down the road, the GDP is 4.3 instead of 4.5. Who cares? Nobody. So that's the big overarching economic point. The other point, more important, I think, for investors, as you raise, is the earnings point. And there, I thought it was interesting. I don't really know the impact on European projected earnings, but I do know in the U.S. that I think it was J.P. Morgan noted that Q3 earnings in the U.S. are forecast to be down about 7% versus Q2, and that's a fairly significant decrease. And so that's the forecast number. And so they actually were making the point that they think the bar is a pretty low bar to beat. And I would just make a third point, and that's in the U.S. at least. I would just make a third point, which is that everyone's worried about inflation. And keep in mind that inflation means companies can pass, price increases through. And so I do think that if you look at the early, certainly the first blush of earnings that come through in the U.S., that's been the case, where earnings have been better than expected, and that the top line has been better than expected. So I think, in essence, we're in this transition period still. I think the good news is that has made what had been headwinds, namely sentiment. Sentiment had been quite bullish. Now that's no longer the case. Positioning had been quite long. Definitely no longer the case. And seasonality. Seasonality had been, the August-September period known to be one of the worst periods. Now we're coming out of that, going into one of the best periods. So I think there are a lot of things lining up to suggest that we could have a performance chase into year end. And I noted that Goldman Sachs late last week came out calling for exactly that. And they added the point, which I hadn't thought of, which is that November and December are the number 1 and number 2 months for stock buybacks in the United States. And so they expect to see considerable amounts of stock buybacks in the next couple of months. And they also note that the systematic traders, the CTA community, had been huge sellers in September, have now flipped back to buying. So that's another kind of part of the investment community that has flipped the script from selling to buying. So I would note that one of the guys I like to look to for the technical stuff at All-Star Charts, J.C. Parrots, noted that 91% of the S&P 500 constituents have already had a 10% correction, and something like 98% of the NASDAQ constituents have already had a 10% correction. So we have had a stealth correction already for the bulk of the market. And so to me, I think we're well set up. Earnings, I think, are going to be fine. We already discussed it. The bar is low. Yeah. It's 7% below where Q2 was. And we're looking at a world where we have the reopening in Asia, which we talked about a month or so ago. That was something that we highlighted. That leads to strategic, or sorry, not strategic, to the synchronized global expansion, which is the strategic outlook that we have here at TPW Advisory. It is interesting. One of the things that I talk about in the musings was how the commodity space, commodity asset class is the strongest looking one technically, stronger than equities, obviously stronger than fixed income. And I note that it's rare that the dollar go up and commodities go up at the same time. And one of the ways that you can note that commodities are really in a strong bull market is that 100% of the Goldman Sachs Commodity Index constituents are up on a 3-year rolling basis. That's the first time in 17 years that 100% of that index is up on a rolling basis. So you have a very strong commodity bull market, even with dollar appreciation. And typically, as I say, that doesn't last very long. What happens is that the dollar rolls over and then commodities get that next leg. So if you think about, if you think about what commodities have done so far with a stronger dollar, imagine what might happen should the dollar weaken to commodities. I do think that the Fed taper is most likely going to be the top for the dollar because I think that that's the news will then be clearly in the price. I think that next year we're going to see Europe and Japan grow faster than the United States. This is a key point that people haven't really gotten their heads wrapped around yet. Japan is the only major economy with this composite PMI under 50. Japan has a real opportunity to grow next year faster than the United States. Europe is going to grow most likely faster than the United States in 2022. So that will be the mindset that people have to focus on, as opposed to the exceptional nature of the U.S. fiscal response, the on and off exceptional nature of the U.S. response to COVID. But taper, I think, is more likely than not to mean that the dollar peak and then it starts to roll over, gives commodities and non-U.S. equities and cyclicals and value, the next leg up, because you need to see continued catalysts for further appreciation on some of those transitions that we talked about. And I do think that commodities are definitely one, and a weaker dollar is the next leg, could provide the next leg up for the broad commodity space. Yeah, well, the playbook for year end is based off of the idea that we will have a chase into year end, that all the headwinds of the last couple months have turned into tailwinds, that we have had a stealth correction, that we are having the Asian reopening. We are going to have a synchronized global expansion spanning 2022, 2023, and perhaps beyond. And so we want to position our portfolios, and we have positioned our model portfolios, both our TPW 20 thematic model as well as our global multi-asset model, for that type of environment. So we are, overweight equities. We are significantly underweight fixed income, and we are overweight commodities, which, as I mentioned earlier in the session, I think is the strongest looking of the three main asset classes. And within the equity position, we are overweight non-U.S. equities, as we have been. The focus on Europe and Japan, particularly Japan. I would just point out that in September, there were a bunch of things that were kind of tossed out, baby with the bathwater style, as people reorganized their portfolios for the end of the month, end of quarter. and one of them was Japan. And I forget the firm that made this point, but one of the big Wall Street firms highlighted that the amount of foreign selling of Japanese equity in September was something like $7 billion, the biggest single month sale of Japanese equity since 2012. So we're really focused on Japan. We think it's a cyclical market, under-owned market, cheap market with a new government, a stimulus package likely coming. And as I pointed out earlier, it's got tremendous growth upside to catch up to what's been kind of 2 years almost for Japan of lost economic activity because of the severity of their lockdowns. 2021 has been pretty much a write-off. 2022, I think Japan will grow in a way that hasn't been seen in a number of years, perhaps even grow more than the United States. So overweight non-US equity. Also focusing on some of the emerging markets. I mentioned Russia earlier on the energy play into Europe. Also Asia. We haven't sold a single ETF of our Asian equity exposure throughout the last couple months of all this China bashing. And then within the reopening trade, we continue to really like jets. The airline, we do think, I mean, the U.S. is opening its borders to vaccinated folks starting in less than a month, 3 weeks or so from now. So I do think that we like the jets opportunity on the reopening. And we continue to think that energy has broken out. So within the U.S. equity in particular, we're very heavily overweight cyclical and value, namely XLF and XLE, also AMP. Really like the energy space, and I think it's important to not sell energy too early. That I think would be a mistake if you look at any of the longer term charts. Yeah, if you look over the last 3 months or 6 months, energy looks like it's massively outperformed and we should sell it. But since COVID began, XLE is underperforming the S&P by about 25%. And over the last several years, it's underperforming by about 75%. So that suggests not to sell too early. And then on the financials, we like XLF. You mentioned the U.S. banks, but really the opportunity, I think, continues to be in Europe. The European banks sell at 9 times forward earnings. They traded at a 40% discount to the broader European stock market. And so there's really where I think the opportunity is, even more so than in XLF in the United States. And then last, but certainly not least, is the contrarian play, right? I actually did these notes for a Bloomberg hit on Thursday morning, which, because of some technical difficulties on my end, ended up being just a phone chat for 5 minutes or so. But the notes on the musings last week really were from that Bloomberg appearance. And I noted that a contrarian play, which is the China equity opportunity. And so we touched on it a couple of times here in this live session. But to me, it's been every reason to sell. You've been given multiple opportunities to sell. China now is super cheap relative to its history, relative to the U.S. Tech stocks in China haven't been this cheap in years and years. So I think China equity, if you're looking, and that's often what happens when markets start to move up, people look at the things that haven't moved and buy them and catch the ride that way. And I think if you're thinking about doing something like that, you can't do much better than looking to get long China equity. I think very little downside and some pretty decent upside. So that's kind of the playbook for TPW Advisory as we head into year end. Pretty constructive, and thinking that the headwinds of the last several months have turned into tailwinds, and that's going to take us higher. Yeah, well, there's always, and you need to have an answer. You certainly should. I think what went wrong, you could have another Delta variant come out of nowhere and be vaccine resistant. That's the single biggest one that I think we have to start off with, given what we've seen in the last 2 years. There's no sign of that, which is wonderful. And so I think hopefully we can continue to vaccinate more and more people around the world so that the potential for variants to kind of grow in spaces where there hasn't been good vaccination become less and less. I think that's one. Two, I guess, would be a major policy mistake from perhaps the Fed, some skipping tapering and going right to tight or something like that. I think it's extremely unlikely, but that would be another. And then I think, again, you think about what drives stocks. I mean, we're most overweight equities and commodities. So what is our risk? Our risk is that something derails the bull markets in both. In the equity side, it's earnings. So I guess there could be the dramatic margin compression as a result of some of the supply demand imbalances and issues around labor, et cetera. That could be one. I don't think that plays out in the course of a couple of months. That's a couple of years. And I'm on the other side of that. I think there's going to be productivity and,
that's what I was going to say.
My view is that we have three big factors supporting the global economy, right? I guess the third one, and we can stop here, is if the strategic outlook of a synchronized global expansion doesn't materialize, then we should probably not be as overweight on equities or commodities as we are. Now, why do I think that we're going to have that synchronized global expansion? First of all, because all three regions are now reopening, right? Asia, Europe, and the Americas. And then secondly, we have three drivers, I believe, to strong global growth over the next couple of years. One is inventory restocking, right? All we're hearing about is, supply chain woes and stuff shortages. So we have a massive inventory rebuild and restock. We have very strong consumer demand, record household net worth in the US and in Europe, right? Stocks at all-time highs, housing prices never been higher, debt servicing never been lower as a percentage of household wealth. So very strong consumer demand and capacity. And then third, the CapEx boom that I think has been kind of kicked off by COVID, as companies have had to figure out how to produce without as many people or with fewer plants, et cetera. And then you have the climate change, like we just talked about with the electric vehicles and with lithium. The need to build out the global charging network is going to be significant. I think there's a CapEx boom that's quite likely to unfold. Companies have never had as much cash. Borrowing costs have never been lower. And if you're going to actually have wage hikes of a significant nature, then the impetus to replace labor with capital, manifests itself in a way that leads to more CapEx as well. And that, importantly, the thing that I'm watching for, all that I think is almost a given. What I'm watching for is the productivity surge that comes about from a CapEx boom, which allows and offsets the wage inflation pressure so that you get higher growth, both nominal and real. The nominal, higher GDP on a nominal basis is a given. It's a question of real. And so how much of that inflation gets taken away by the productivity increase? And we've had this in the 1990s. And I wrote a piece
that's what
not too long ago, back to the 1990s. Yeah, back to the 1990s. And the second half of the 90s, 95 to 99, was exactly this kind of an environment. You had a CapEx boom. You had productivity surge. You had 4.5% to 5% wages increase on average for 4 or 5 years. And yet inflation was only 2 to 3% because productivity growth was 2 to 3%. And it that the inflationary part of the wage gain in half. And by the way, stocks averaged something like 15 to 20% a year. Yeah, some very, very good number. And frankly, I don't expect to see that in the United States. That could happen in the non-US markets. But the US, because of the big weight of the tech companies, I don't think that's going to happen in the US, because US will see higher interest rates. Those higher interest rates will act as a cap on the upside for the big cap growth tech stocks. And that will act as an anchor to the broad US equity market, which is why, on a strategic basis, I think the opportunity set is much more attractive outside the US than inside the US.